Welcome to Subramani. Every few days you will get a report or somebody saying that the younger generation, which means who are in their 20s and 30s, are no longer interested in investing. And you will also hear that 1 crore new accounts have been opened and so many people are now buying and selling shares, so which means they are trading. Let's face it, most of us must have started our lives as traders. We would have bought a share, suddenly you saw it go up. I remember I bought a share for 1,250 rupees, it went up and I sold it for 1,550 rupees. So 200, 300 rupees I made, which was big money. It would take care of all my eating out expenses for the month in case I wanted to, right? So everybody starts like that, and so if I'm very happy if 1 crore new people are entering the markets. That's a big number even for a country like India. Can it be higher? Of course it can be higher. Are people buying shares? Are people selling shares? I don't know, because I see both kinds of people. I see people wanting to get into day trade, get scarred and then go away and then not come back. I also see a lot of people opening up new mutual funds and starting to invest either a lump sum or an SIP, and that's also happening. So let us look at the reasons why people don't invest in direct equity. I know a lot of people who would have, this is just like the proverbial cat that doesn't drink milk. So somebody had kept boiling milk, so the cat had burnt its tongue, so it did it once, it did it twice, and now it is not even drinking, it's not drinking anything white. It thinks anything white will it just runs away, right? So if a cat has been trained to do that, or a hot stove which you touched and you burnt your hand, and that means you're going to be careful about ever touching a stove. Well, is it good, bad? I don't know, but if you burnt your fingers at 23, maybe at 25 you will have the guts to come back into the market, or maybe 27 you will come back into the market. That is one set of people who have lost money themselves. The other set of people are those people who have seen their parents lose money during Harshad Mehta time, during Ketan Parikh's time, or whenever else. Now this is again a contradiction. You have not lost money because of the markets. You lost money because of the stocks that you chose. If you had bought Asian Paints in 1982 or 1992 or 2002 or 2012, you would have still made money. The question is, during Harshad's peak, if you went and bought Mazda Industries, you would have definitely lost money. So every few years you will find something like this, some music company, some finance company or something which will get you nothing. You are just finished, right? Well, you learned it the hard way. Now what happens is, when children see their parents getting wiped out, or the parents fighting, the father putting a lot of money in equity, the mother shouting, and then everything being lost and they shifting residence because of that, the house being sold off and things like that, then yes, the children are scarred and they will not touch equity. That's fine, it doesn't matter. Then there are those who earn very, very well and who think that they don't need to invest in equities. So be it. There is a person whom I know who earns about 12-13 lakhs per year, and his expenses are not more than 1,25,000 or maybe 1,50,000. That's all he spends in a year, right? So when a person is earning 12 lakhs and spending only 1.5 lakhs, for him it won't really matter even if you put all the money in a debt market mutual fund. Only thing is, the bank FD would incur excess income tax for him. So yes, it makes sense for him to put money in debt funds. That's perfectly all right, right? So another reason which one young boy told me, and I liked it quite a bit, and he said the problem is the following people have lost complete credibility in whatever they say about the markets. And he listed literally everyone. So brokerage firm analysts, global strategists, chief economist of a big broking company or a big investment bank, professor of economics, almost every single regulatory body in the world, whether it is SEBI or IRDA or RBI or SEC, there are enough mistakes. There is no regulator performance audit. I don't see why Government of India should not do it, saying appoint a high-powered parliamentary committee to review what RBI was supposed to do and what it is doing, and what SEBI, IRDA, what were they supposed to do and what have they done. I mean, this has to go through every regulator, including the telecom regulator, TRAI. Just go and check what they were supposed to do. For example, TRAI has ensured, for whatever reasons, the industry has ensured that mobile penetration in India is awesome. Most people who can afford to have a mobile, it has been completely turned on its head. Landline used to be considered to be a luxury in the 1970s. Today, not having a phone will mean you will not be able to participate in any of the growth in this country that is happening, right? So, yes, loss of credibility of the regulator, complete loss of credibility of the persons who rate. Rating agencies have gone for a toss. I mean, 2008, 2009, they were exposed even worse, and I see no reason why they should exist. If a guy is wanting to put in 100 crores, why should he rely on the rating? He has to do his own due diligence, right? So after he does his due diligence, he can still take a report and say, okay, this is what I'm doing. But I don't think rating substitutes the need to check the data, especially if you're a big time investor, whether corporate or no, right? Taleb came and destroyed all the private sector sales guys, right? So the public sector sales guys or the bank sales guys, completely value destroyed, because Taleb said one thing very nicely is do not trust an employee, which is very clear, because when a person is working in one particular bank, he'll talk about that bank, and when he shifts, he'll talk about another bank. Economics, Keynesian theory, Modinomics, Thatcherism, everything was tested, many things broke, many things fell apart, right? The ability of our bankers and of our politicians to understand what is in the economy, very doubtful. There are a few bankers who understand, who can anticipate, who are almost clairvoyant, but they are the exception. 3 out of 3 million is not a great number. The probability of finding them is almost impossible. The chance of meeting them and asking them basic questions, again, I think impossible. The sagacity of RBI, of Federal Reserve, and their ability to run the market. Today, the equity market is run by those people, not by you and me, not by the institutional investors, but by the central government, or rather the Reserve Bank. The structural integrity of the stock exchange also is in question. GameStop proved that the systems are just not sufficient to protect the small guy, big guy, anybody who loses money. If you lose money, you're doomed. But if you gain money and the person who has lost money is big and powerful, remember the old rule: the man who has the gold makes the rules. So gold, that's a simple golden rule. So the profits will be disgorged from you and given to that person. So the boomers have seen all this and all the institutions crumbling in front of their eyes. Asking them to trust these organizations is going to be very difficult. Even if you want to push, you will have to push very carefully, because this generation is not like the previous one. They don't like to be pushed. They may or may not invest. They may or may not invest in index funds. They will experiment with equities, and I think it is a must that people should experiment with equities, and after some stage of 4 or 5 years say, okay, it didn't work too great, so I will continue my index funds, which means you have to start your index funds the day you're starting to invest, right? I think I've run out of things to say. Thank you.